Good morning, good afternoon, and welcome back to the new era of agriculture commodity trade. Welcome to the session 2, day 6 of Commodity Week World 2026 or CWW26. Just a visual and mic check. Neeraj, am I audible and visible?
Yes, sir. Loud and clear.
Awesome. So earlier today, we opened the day 6 by dissecting the production heavyweights and massive ethanol pivots of the Asia-Pacific sugar corridor. Now we are chasing the sun westward to explore a highly complex, heavily regulated, and structurally deficit region. Welcome to the sugar, Europe, Middle East, and Africa war room. The agriculture value chain has crossed a critical threshold. The traditional playbooks, the one that relied on predictable crop cycles, stable freight corridors, and reliable trade alliances have officially expired. Trade is no longer observing cyclical market corrections. Operations are running within the baseline of permanent structural volatility. Over the final day, our tactical session will continue, bringing the global boardroom directly to the screen. CWW26, organized by HnyB Tech Incubations and Know Your Commodity, is presented by AgriGuru Online and is supported by Kripco Agri, Bajrang Group International, and Bingani Group, along with our association partners, OATA Myanmar, Ukraine Pulses and Soybean Association, and GOPKI Indonesia. Other institution partners include Solidaridad and World Cooperation Economic Forum. CWW26 is moving entirely beyond the delayed data of historical balance sheet and scripted presentations. This is an unscripted, unfiltered war room. The mission is to democratize high-stake market intelligence, mitigate the systemic risk of information asymmetry, and equip market participants with the foresight needed to defend margins and ensure equity for producers and consumers alike. As a reminder, these sessions are beamed live across multiple digital assets on LinkedIn, YouTube, X, Facebook, and our own event website. Let's take a macro view. While the grain provided basic caloric survival for all, oilseed dominate global feeds and fats, and pulses the nutrition security. The sugar complex is experiencing an unprecedented structural revolution. It is no longer just a global food staple, it is primary feedstock for the worldwide ethanol and bioenergy transition as well. Globally, the sugar balance sheet is attempting to stabilize, but the supply-demand metrics remains incredibly sensitive. According to the latest estimates, global sugar production for 2025-26 season was record 182 million tons, marking a 3.5% year-on-year increase. The robust production recovery has raised the 2025-26 global sugar surplus estimate to 2.2 million tons, rebounding sharply from 3.46 million ton of deficit witnessed in the previous cycle. However, looking ahead for 2026-27 cycle, global sugar production is forecasted to contract by roughly 2% year-on-year, down to 178 to 180 million metric tons. While a global surplus currently exists on paper, it remains incredibly fragile. Any unexpected surges in ethanol diversion or late season weather anomalies can rapidly erode the 2.2 million ton buffer, keeping baseline physical availability tight. To understand how these global tightening trends translate into physical trade, risk for importing nations, and critical refining hubs, the focus must shift directly to the complex regulatory and demographic crucible of EMEA region. Which brings the broadcast directly to the second panel of the day, the EMEA theater. Here in Europe and Middle East and Africa, the sugar narrative shifts from raw production dominance to complex refining economics, severe regulatory constraint, and surging demographic demand. The region does not just consume sugar, it refines, regulates, and re-exports it across highly volatile maritime corridors. Let's break down the critical EMEA pressure points. First, the European regulatory and beat metrics. Europe operates under the tightest agriculture regulatory environment on the planet. Estimate pegs European sugar production navigating around 15.5 to 16.5 million tons threshold. However, the strict environmental mandates, including pesticide restrictions and sweeping sustainability law, are structurally capping the beet yields. Against a regional consumption base of roughly 17 million metric tons, Europe remains a finely balanced net importing environment. The continent must dynamically manage the preferential imports while protecting its internal food processing margins. For the European market, procurement is no longer just about balancing physical supply, it is actively pricing in the absolute cost of regulatory compliance as well. Second, the Middle Eastern refining crucible. The Middle East is indispensable refining bridge between global raw sugar origins and destination demands. Operating with a consumption and refining requirement pulling well over 13 million tons annually, the region is highly dependent on deep water raw imports from Brazil and Asia. Buyers here are caught in severe logistic and financial squeeze currently. Navigating the geopolitical friction in the Red Sea and West Asia Skyrocketing maritime war risk premiums and volatile energy overheads make sourcing raw feedstock and maintaining white sugar export margin to East Africa and Mediterranean a daily battle for survival. Third, the African demand is surging. Africa represents the most explosive demographic demand curve in the global sugar complex. While domestic production across the continent hovers around 11 to 12 million metric ton, consumption is pretty high, outpacing the production. It is tracking upward of 20 to 22 million metric tons. This leaves sub-Saharan Africa as a massive structural deficit zone requiring nearly 10 million tons of imports. Buyers in the region are fully exposed to global flat prices and are simultaneously battling acute macroeconomic headwinds, severe local currency devaluation, and chronic dollar shortages. For procurement executive across Africa, securing physical sugar is an immediate fight for basic food security. Let's open the war room. The day of relying on lagging monthly reports to make multi-million dollar procurement decisions are over. Navigating this complex, heavily financialized market requires elite ground-level foresight. That foresight is going to be extracted right now. An elite strike force of EME sugar expert have been assembled. This panel features the physical merchant who manage cross-border flows, the macro analysts who model institutional supply-demand deltas, and corporate decision makers executing large-scale procurement amidst the regulatory and macroeconomic chaos. The mandate for this session is simple: no script, no filters, pure intelligence. The session will dissect European beet margins, analyze the real-time impact of West Asia logistic friction on Middle Eastern refiners, and uncover the critical value premiums hiding within the Africa supply chain disruption. To the live audience, prepare to rethink the coverage strategies. The market does not wait, and neither should the industry. It is time to secure a strategic edge. Welcome to day 6 of Commodity Week World 2026. Let's officially open the Sugar, Europe, Middle East, and Africa War Room. With that, let me invite my first speaker, RJ Leo. RJ Leo is Managing Director of CapFix, a global commodity, energy, and trade finance platform operating across Asia, Africa, and Middle East. With over 3 decades of experience, he works at the intersection of physical trade and capital, structuring and facilitating the transactions across sugar, soybean, edible oil, and energy markets, including EN 590, D6, and Jet A1. RJ is recognized for bridging complex market and aligning credible counterparties into executable bankable deals. With a disciplined focus on pricing risk and certainty of delivery, he is also an international speaker and author of Marketing Halal, Creating New Economy, New Wealth, known for delivering clear real-world insight on navigating the global trade in volatile environment. Welcome, RJ. Pleasure to have you.
Hello, Deepak. How are you? Good
All
morning.
good.
Good to you. Afternoon as
Yeah.
well.
Yeah. Awesome. So I think RJ, you'll be making a presentation, right?
Yes, I believe the your team will present. You screen the presentation for me.
Yeah. Okay. We'll do that. Just give me a second.
Thank you very much. Yeah, that will save my technical, just in case, you know.
No, don't worry. We'll do that. We'll do that for
Yeah.
sure.
You're busy for the past few days, huh?
Yeah, it is 6 day, pretty hectic, but surviving. And the best thing is that actually engaging with expert like yourself,
Yeah.
right, is a great way of learning. So I would
Yes.
say the whole time has gone in learning and nothing else. So not an issue. And here we go. Just give me a second.
Yeah.
Share. And yep. Let me know when you can see the screen.
Okay. Yes, I can see now.
Awesome. So go ahead. Floor is yours.
Okay. Thank you very much, Deepak. Good afternoon, everybody. This is an honor to be invited here to share my learning, I would say, for in the many years that I've been in this industry. Sugar has been our flagship product, and we have a lot of learning, uh, painful learning as well. The curve is tough, but today I'm going to share with you the real journey that I've been through. Hopefully, it will help you in your journey as well. Today, we talk about the sugar structure and certainty. The key word is certainty and the structure. And how does the trade finance, energy markets, and the global execution framework reshaping the way we buy and sell sugar? Next, please. Yeah, next slide, please. Okay, a little bit of myself just now, but thanks a lot for already giving the very nice introduction. 3 points from me. I came from a management buyout system many years ago. We about 10 of us we sold our share to in fact, to the company that I'm going to introduce to you, India, that you know. 30 years in this international market entry and development. This is my favorite part of the business. I'm a speaker, mentor, and author. Next, please. I think for those who are in India, perhaps you know this gentleman. All right, this is Mr. Azim bin Prinji. He's a billionaire founder of Wipro. Wipro is a very, very large company based in Bangalore, and are listed in India and also in US. So back in 2008, a group of us, 10 of us, we sold our company to Mr. Pinji. And you can see the brand down there. That's one of our brand. We sold 40 brands and the entire company structure about covering about 5 or 6 countries to Mr. Pinji, including the market of international export. We total 30 markets all to Wipro. Next. I did this one, the book I wrote, and I'm very fortunate that it got into the top 10 business bestseller in Malaysia. This is about marketing halal. I'm a non-Muslim, so it make it very unique. Almost every time one the very few non-Muslim speaker giving my view in the conferences because they like to see the different objective view. Next, please. Okay, this is my company, CapFix. We are a platform. Okay, this company we have 2 main verticals. CapFix every commodities where we connect the buyer and the sellers in the every commodity with sugar, which is topic for today, and flagship products. And on the other side, we have the energy, right? EM590, D6A1. This new vertical we added last year to balance up the not the heavy reliance on only one vertical. And we have supplementary vertical, FinTrade. We help company to monetize the SPLC and issue the SPLC to complete the purchase of our commodities. We also have a team of experts to give talk, and we have a complete line of AI tools for the commodity life cycle. Depends on which cycle that you want to purchase. Okay, next, please. Okay, this is my passion, my most passionate component of my business. I like to do the consultancy work and the mentorship. So if anybody in the audience would like to venture into capital market or work into overseas market, please contact us. We'll help you to enter the market. And our goal is very simple: give you a growth and a sustainable profitability. Next, please. Okay, let's zoom into the presentation proper. In my many years in this commodity business, right, there's been a lot of failures. In fact, the failure rate is very, very high. I even start to compile in the Excel list, Excel sheet, a list of failed deals. In fact, I think this is my advice to anybody here. This will be good for you to maintain a sheet of all the failed deals. From here, you can be able to have the database to analyze what gone wrong and why the reason that certain deal did not go through. And I have many deals that fail. So now I have a good database to let me know what have gone wrong. But the most deal failures are not caused by the bad prices. And prices is never the problem. Quality is not a problem. It's always because of bad processes, right? This is very consistent in all the years and all the failure we have. Okay, just give the audience a little brief bird eye views. Deepak has shared some very good data just now, and this just a simplified data give a bird eye view. There are close to 200 million sugar being traded globally per year, right? 60 billion total is the market value, and Brazil is a 40% contributor of the total world supply. Right? For CapFix, we focus on only Brazilian sugar. We don't do Thailand, we don't do India, only Brazilian sugar. And Africa and Middle East market is correctly pointed out by Tepo, is an emerging market. We place a lot of emphasis in this market simply because there's too high failure in the Asia side, where China is particularly a very tough market to get in. And 80% of deal fail is because of the payment instrument. 80%. 10 order comes in, 8 will fail simply because of the instrument. Next, please. Okay, this is what we learned throughout the year on how to build a sugar deal that probably increase the chance of closing. First of all, you need to qualify the buyer. This is very important. And we realized that by asking one simple question, you will eliminate almost 80% of the unwanted deals. Right? Those are illusion. Those are not real deals. But in the very beginning year, we keep chasing those deals. We thought good margin, good volume, right? Make us very rich, but it's not a real one. Today, I asked all my team to ask one question. First question, what's the name of the bank that you as a buyer going to use to buy the sugar? You'll be surprised. A lot of company cannot answer this simple questions, and also not to mention the intermediaries. So by not able to answer this question, then you know this is not a genuine and or the not a really ready buyers. So then you can move on to your next deal. You do not need to waste time or waste your time on this one. The next important one is a fixed instrument. That here again, in the past, we chasing any company who give any instruments from any bank. We don't even mind. It is a non-rated bank. But now we learn the hard way, right? You may have a quick start at the beginning, but most deal will be rejected by the receiving bank. So there's no point to get it started, do the paperwork, and it doesn't work, and we fail later. And it had to be a top 100 bank, definitely. And in our database, for those buyers who use third-party financial, it's 100% failure. 100%. So so we need to be careful on when any buyer who use third-party financial, we need to find out more information. Of course, the third is a common sense, appointed SGS, independent inspection, and then we log the SPA. Here, important part is the tripartite SPA, because some seller using financial themselves as well. So we need to hold their financial responsibility for delivering the sugar to our buyer. Remember, Catfish is a platform. We facilitate buyer and seller. We match the buyer to the most compatible seller. So our objective and our goal is to maintain neutral and ensure that the deal really happen. Of course, the last one is closing the chain. You see, a lot of intermediary, they do not have their mindset is just connecting. Then they leave it all the job to the seller. But just word of advice, as an intermediary, our job is to also facilitate and try to manage and close the deal for buyer and seller. We just leave it to the buyer and seller themselves, because they are the first time to meet. They are stranger to each other, and most of the time you realize that the deal just collapsed due to ego or emotion. Next, please. Okay, this is a flow from Brazilian mill to discharge port. What are the key components? Of course, there are many components, but these are key, top 6. Brazilian millers, the top 3 sugars will be the Icunza 45, 150, and VHP. We focus almost 90% on Icunza 45, and that's good enough to keep us busy. And in Brazilian mill, there's a lot of TT payment required, and the millers don't really wait. In the past, when we first started, we thought as a national thinking, we should go to Brazil and buy from the millers. But we learned throughout the years that the best way to buy is actually go to the allotment holder, right? Where they supply to the trading companies, where these companies are more accommodating to buyers' requirement in terms of instruments, because most buyers, they do not pay TT to the supplier. So then the buyer's bank, again, we mentioned just now, this costs 80% of the failure. in the sugar business. Need to have it. Top 100 bank, there's no compromise. We need to have it. And of course, SGS inspection, you'll be surprised. Some buyer, they are quite reluctant to attend the inspection, and they complain what they bought and what arrived in their destination port are different products. But I just had a taste. Sorry, this you have yourself the brain. You need to be there, present, see the loading, make sure that the product you order are loaded to the vessel. Then you will ensure that you will receive the same product at the other end. Okay, payment release. This is another challenge and caused a lot of failure upfront, especially for buyer in China. They wanted payment at discharge port. This is a direct conflict of this procedure for the seller. So for China buyer, normally our first question is not a bank. It's about what's the payment method? Is it payment at discharge port or loading port? The minute they say discharge port, you know the deal will not proceed. So depends on the geographical reason. At the end, discharge port, this is very important that buyer need to ensure that they have the performance bond issued in their favor. In terms of non-performance, you will get it. And then the shipping 100%. Next, please. Next, please. Okay, just simply very quickly on the Africa and the Middle East. Again, just one filter question. Do you have top 100 bank? If not, get a confirming bank, which is top 100. It's very, very important. Next, please. Okay, this one, I just want one point to highlight. This is what, because we do it in energy industry as well. One thing I like to highlight for the sugar player, the trader, is that in energy product, the industry, the deal move very, very fast. It's within 721 days, you can close. But in sugar, it can take up to 3 months. So this is something that we should learn. And the most important thing is pre-qualify the buyers. Next, please. And these are the 4 risks, right, that a trader need to manage simultaneously, concurrently, right? The price, the currency, the logistic, and the payment risks. Okay, so we as a platform owner, we don't need to worry about this, but the seller will have these 4 to concern. Next, please. Okay, on the next step, what is the opportunity for the new wealth? Okay, I identified 4 areas where the trading houses can consider. First one is sugar specific, especially Africa. Right now, they're building their own refineries. I think it's wrong to go in and take the order fast and lock the supply. Second is a halal industry. Right? Halal, this segment requires a halal certified sugar and supply chain. This is one thing that you can stand up and be differentiate from other competitors. And the other thing is, of course, the sugar to energy, which is our area, energy side, right? Sugarcane, ethanol is a $30 billion business. A seller can play both sides and win both sides. And the last one is the monetize now about the AI. This is about AI. If you have data, especially if you have buyer seller matching data, this is fantastic and this is most needed for all the sellers. Next, please. Okay, this is just a summarize on our ecosystem. We have all these 9 verticals. We are now in 20 countries, our global partners. We have played in soft and hard commodities. And then we have 9 verticals to help to make a deal happen. Next, please. Okay, this is my closing thought. Okay? The future belongs not to those who own the most commodities, but to those who can create the most certainty. The key word is certainty within the global food economy. So this is the thing that I need to I let pro out and advise the trader in this market to pay more attention to. Okay, next one. Okay, so this is where you can connect me. Go to LinkedIn. I post my learning every day. The bad learning, good learning, I post every day, I share. And you can go to my website and visit us and see how we action. Thank you very much.
Mute. So thanks a lot, Ajay. Unfortunately, we have run a little bit out of time. So I would thank you for joining. And with that, we would like to move to our next speaker. And we are having in-house one of the smartest industry player, Kona Haq. She is a world-renowned macroeconomist and commodity strategist with a stellar career featuring senior global leadership role at ED&F Man and Macquarie Bank and the Economist Group, specializing in the soft commodity sectors, especially sugar, coffee, and cocoa. She excelled at synthesizing the monetary policies, currency trends, and the macroeconomic indicators with physical fundamentals. She is a highly popular global media contributor with BBC, Bloomberg, to name a few, celebrated for her incisive forecast regarding international food system, energy cost, and ESG-driven structural demand shift. Hi, Kona. Good to see you again.
Hi, Deepak. How are you? Very nice to be here.
My pleasure, ma'am. All good. God has been kind. So, Kona, straight away into the question, how do you see sugar balance sheet going forward?
Okay, so it's not straightforward. I think at the beginning of the Iran-US war, there was quite a bit of excitement building up, and there was this anticipation that the rise in the crude oil price was going to lead to a ethanol-linked rally in sugar prices. You know, there was this expectation that the Brazilian sugar millers would basically be diverting a lot of their sugar cane towards ethanol at the expense of sugar. So that meant that Brazilian sugar exports might be reduced. Then there was some excitement about El Nino affecting Asian crops, you know, India, Thailand, Australia, and that there might be some yield issues there. But the reality is that the sugar market is actually fairly well supplied today. Obviously 25, 26, we have a surplus, not a massive surplus, but it's a surplus nonetheless. And the expectation was that we were going to go into the 26, 27 season, which starts in October, with a balanced situation. So it's effectively, the reasons I mentioned before would have effectively wiped out the surplus. However, on closer inspection, what we're noticing is that the Brazilian crop, which is obviously the world's largest producer, is actually thriving. The weather has been very kind. It's been nice and dry, but not dry enough to impact yields, but dry enough to allow the crush at the start of the crop to really run at pace. So we're seeing strong year-on-year expansion in cane production. And the crop is going to be a big one, you know, one of the all-time highs. So I think that alone is offsetting concerns about how much will be diverted. So I think that is your biggest, if you like, bear flag, if you want. I don't want to be completely bearish. I'd say the market is fairly nuanced. I think there are quite a few bullish and bearish market flags to mention. But I think for Brazil, it's important to pay a little bit of attention there, because on the one hand, they do have a very, very big crop potentially. Admittedly, we have El Nino around the corner, and the world, the United Nations and all the big weather meteorologists are suggesting that this one will be a super one. And if that's the case, then Brazil will be dry, wetter than normal. So you could start seeing some disruption to the cane crush. But for now, it's dry and the crop is running very, very rapidly. But the problem is the ethanol. Now, clearly, crude oil prices have been rallying. They've been sort of stable for now, but they have been rallying quite rapidly. And this has been causing ethanol prices to become more attractive for the Brazilian miller, at least. On the other hand, at the pump level, it's not low enough because of subsidies for gasoline, which means that at the pump level, there's not enough consumption for fuel consumption from the drivers for ethanol. So unless that happens, that big diversion that people are expecting towards cane, towards ethanol, is not going to happen. So I think there's a bit of a question mark there. Then you have other crops like, you know, India, for example. India has lowish stocks, and I think there is a big flag on the El Nino there. But they have decided that they're going to reduce or cut exports. I think that's going to be one thing to watch out for. And we're going to see the monsoon, how quickly it arrives. It's a bit of a delay in Kerala. It's started coming a little bit in delays. But again, it's super early just yet. The fund positioning on sugar is at the moment quite negative. In fact, I think the last CFTC report suggests that the hedge funds are actually increasing their bearish positioning. So to me, it sounds like they don't think there is an imminent shortage in the sugar market supply demand balance. Clearly, prices have been trending low for the last 2 to 3 years in sugar, and I think what you're starting to see is a reaction to that. And I think that's going to be, in Europe, we're going to see that, for example, there's going to be lower acreage after 2 record harvests in Europe. So I think there's some potentially supply reductions there on the cards. Thailand could start seeing a switch to cassava with the low sugar prices as well. And as I mentioned, Brazil to ethanol. But none of that's going to have an immediate impact. It could be an impact more for the 2020-27 crop. And I think, we just have to watch weather issues for now. The problem on the other side of the equation, which is the demand, is that demand growth rates for sugar really, really is stalling. Importers seem to have stocked up quite nicely. China in particular, the low prices have allowed them to stock up nicely. So even today, we're not seeing a massive increase in import demand. And I think generally speaking, with the obesity and low population growth and all this inflation uncertainty, you are seeing a big slowdown in consumption for sugar globally. So all things considered, I'd say, we are in a current surplus. The new crop starting at the end of this year potentially could have seen the market move back into balance, but the big Brazilian crop could actually shift that away back into surplus.
Excellent analysis, Kona, as usual. So, Kona, I would also like to bring a very important aspect, about the macroeconomics. So we are seeing the global monetary policies, right? Whether it's Bank of Japan, whether it is US Fed, all are looking at inflation closer than actually anybody would look at. At the same time, we are also seeing that currency movement in some of the countries which are either large origin like Brazil and as well as large consumers like India. How do you see these two aspects playing on impacting or overriding the global supply and demand equation when it comes to the pricing and the overall global trade of sugar and ethanol?
Yeah, absolutely. So I think obviously you have to look at any market in the context of the global macro picture. And for the global macro, we are clearly in a period of pretty heightened volatility in terms of geopolitical uncertainty. But when it comes to macroeconomics and particularly the interest rate and the currency environment, we seem to be in a bit of a stalling pattern whereby the dollar has been pretty stable for the best part of the year. Now, this is despite the USA today being arguably the biggest source of geopolitical concern. And the fact that the US is running a massive $1 trillion deficit, massive debt potential, and very, very suspect international policy would suggest that there should be more volatility of the dollar, and yet it's not. And the reason why the dollar has been stable is because there is an expectation that the Federal Reserve is going to potentially stall or even hike interest rates. This is completely different from a few months ago when they thought that interest rates would be lowered because there's inflationary expectations because of the war. Number two, there is also the safe haven appeal of the dollar, which basically means that there's people are buying the dollar at times of uncertainty. A lot of the demand that used to go to gold is now going to the dollar. So these are bullish factors that are supporting the dollar. Now, on the flip side, as you mentioned, you have the likes of India, where the Indian rupee is suffering. It's one of the weakest performing currencies year to date because it is a net importer of oil. So the dollar, their dollar reserves are weak, and they have huge import bills. So you've got big currency depreciation in India, but on the other hand, you've got a pretty decent strength in Brazilian real, where they've been benefiting from the rally in commodity prices because of this war again. So it's quite nuanced. I think currency volatility is here to stay. I think oil import dependent economies like India and other Asia will continue to remain under pressure. That will clearly have a negative impact on their import bills, unfortunately. But commodity exporting economies like Brazil and other South American countries, for example, they should, in theory, benefit and see some stabilization in their currencies. Now, I do think, however, that we're not out of this geopolitical uncertainty. I think central bankers around the world are looking carefully. They're watching this inflationary concern building up. Today the oil prices may be stable, but the stocks, oil stocks globally are rapidly being drawn down, nowhere more so than in the USA itself. So in the USA, the gas price is now already at $5 per gallon. There is expectation it could easily get to $5.50, if not $6. Once you start seeing that, you start seeing central banks around the world increasing their interest rates in order to hold down inflation. And then you start seeing a whole round of inflationary concerns and tightening central bank policies. So I think that's something which all the markets have to bear keep in mind with regards to the future.
Perfect. Puna, you have actually dissected the strength of Brazilian currency and the weakness of Indian currency pretty well. Now, that brings me to my last question, and which is very important. According to you, what are the key indicators where the global trading executive should monitor to predict how the soaring energy cost will filter into the soft commodities, processing, and logistics? Right, even that is now playing a very important role, the cost of energy, both in processing and the movement of the commodities.
Okay, so there are a few ways in which this is going to happen. The one we mentioned, which is most glaringly obvious, is clearly this Iran war has led to a very big spike in energy prices, and I do think that's important because at the moment markets, still trading at about $90 per barrel. It's almost in this false sense of security. But the point I mentioned before was that stocks are being drawn down so fast. By the end of this month, when we start coinciding with the US summer driving season, you will start seeing a big pickup in prices, either in order to reduce cause demand destruction, or in order to, just to reflect the supply shortage. So I think you're going to see a massive increase in crude oil, WTI, in particular for the logistics part of thing, diesel and jet fuel prices. So these are the things that are really going to be rising, as well as marine fuel. So marine fuel will mean the shipping of sugar will start to really going up. That freight rate is going to go up. Jet fuel prices obviously means anything airborne. And the diesel, most of the sugar is transported in trucks, etc. So I think that's going to be a massive issue. And I think, particularly keep an eye on the diesel cracks. And then you've got natural gas prices. They seem a little bit underpriced today, but I think, if you think about how important natural gas prices are, it impacts sugar refining, food processing, fertilizer production. And, fertilizer production is one thing that has to be watched because it will have a direct impact on the crops in Brazil, in India, in Thailand, in China, in Europe, in America. So I think this is massively an area which is underestimated. The Hormuz choke point is not just a choke point for energy and crude oil. A third of the world's fertilizer supplies go through that. And at the moment, oil fertilizer prices have already gone up by about 60-70%. So that's something which will have an impact on next year's crop for sure, which if you have an El Nino on top could be something to watch out for sure. Freight is also what we mentioned, the container freight index, the trucking spot rates, rail freights, all of this will have a massive impact on logistics. And then you've got currency. And finally, the other big one that you have to watch is the ethanol and biofuel economics, which I mentioned before in India in particular. You really have to see how the government decides to watch this rising crude oil and energy bill and how they want to tackle that. Do they decide to increase the ethanol and the biofuel mandates, which means more of the cane being diverted towards ethanol? The same in Brazil. And you start seeing more corn being diverted towards ethanol as well, So these are all huge things to be looking at. Electricity prices could also be impacted because of the artificial intelligence, but also because of the power increases. Just, producers should be looking at the input costs, supply, delivery times. These are all indicators which which are very, very crucial to watch. And I think, these indications, indexes in particular, are available pretty much across the macro data. So yeah, it's not an easy time for logistics and producers to be navigating, but there's enough of these early warning signals that can be watched very carefully to see how the logistics are going to be impacted. Keep an eye on inflation, keep an eye on US macroeconomic data, freight, the ethanol biofuel prices and indicators, and the diesel spreads. I think that diesel prices are going to directly impact your transport costs. So I'm sorry, there's a lot of things there, but it will definitely, it's worth watching everything. But the scary thing is that you cannot predict it, because you don't know what Donald Trump's going to wake up in the next morning and think about the war about. So it's anyone's guess.
No, I totally agree. Generally, I used to start my day looking at the prices, global prices, when I get up in the morning. Today, I go to Truth Social to see what has been
exactly.
the new status by the Honorable President of United States of America. So Mr. Trump is actually trumping the whole market on his will. Thank you, Kona. It was a pleasure having you, and great to always hear the insightful talk from you. Thank you.
You're welcome.
So now we move to our next speaker. So we have Mr. Andrew Kerr. He's an expert commodity professional and the CEO and founder of OCR Commodities, a premier global talent recruitment and advisory firm based in London. Drawing on his experience as a former industry insider, he leads a highly specialized team focused on delivering tailored human solution for the world's leading agriculture trade houses. He specializes in sourcing unicorn talent from C-suite executive to elite derivatives traders, possessing the precise technical skill sets required to navigate the modern global market. So, hi, Andrew. Pleasure to have you, sir.
Hi, Deepak. Thank you very much. I feel like a bit of a fraud after the insight from Kona. That was very interesting. Thank you. That was very much enjoyed that. And thank you very much for the introduction.
Yeah, just give me a second to open up your presentation.
Yeah, thanks.
Let me know once you are able to see the screen. It is just loading.
Yeah, no worries. So, yeah, thanks very much. To introduce myself, I'm Andrew Carr. I run OCR Commodities. We are a recruitment company specializing in commodities. So working with commodities companies and people, specifically in the softs and ags markets. I started my career as a trader back in 1992 on the trading floor of the London Commodities Exchange, initially on the cocoa market, and then very soon after in '94 there was a frost in Brazil, so everyone was rallied into that market, into the coffee market, to handle the volatility and trade going through there. So I was pushed into coffee. I transitioned from futures and options as a trader and broker for many years, and then later moved into physical trading, bringing that together in a consultancy. And I guess I kind of started as a broker, and then ended up more in risk management and helping companies. Starting at Rudolph Wolf, which was a metals company, and then I've worked with ED&F Man and Sugden Financial. But the most rewarding and best bit of what I've done has got to be the lifeblood of commodities, which is the people involved in the commodities. So if you could do the next slide, that'd be great. The last 16 years, I've worked with commodities people, from agronomists, farmers, exporters, freight, brokers, traders, bankers, all with a kind of mission to ensure that the right people are in the right companies and vice versa, hoping that we can help all companies and people to kind of reach their full potential in what they can do. As we know, based on recent events, there's been a massive crossover between ags and energy. In fact, Kona was talking about it just now, and metals, not just kind of the sugar, corn to ethanol, but also with higher oil prices. You're looking at logistics. So whilst we're a softs and ags headhunter, there's often loads of crossover into biofuels and then fuels and metals. If you can do the next slide. The two biggest requirements seen by our clients over the last 12 months have got to be solid risk management capabilities and global supply chain and logistics expertise. Again, following on from the previous two speakers, we see an increasing volatile markets across cash and commodities generally. And with Mr. Trump obviously tweeting and putting out different news stories, that's probably set to continue. There's been a tightness of cash, particularly in coffee and cocoa. We've seen some pretty punchy margin requirements there as the markets rallied and then corrected again. A lot of mid-sized commodity trade houses cross-commodity trade houses have had to be very careful with their cash allocation, and we've seen a move from traditional exchange-traded futures and options as hedging mechanisms to more complex OTC strategies. So we've seen our clients having to kind of shift and learn as they go, bringing in the right talent to be able to manage their risk. With this increasing need for more cash, one of the other big trends that we see, and I believe we'll actually continue to see, is that the new investment in our markets, in our ag markets, have been from outside the ag sector. We've seen in the energy sector, you see the Hartree acquisitions, for instance, from the financial sector. You look at StoneX's phenomenal growth, and then sovereign wealth. If we look at Abu Dhabi and Saudi investments recently, and also the rumblings from DP World and their intent in commodities. So that's on the financial side. Moving on to the logistics. Starting post-COVID with containers in the wrong places and execution teams having to be imaginative on their shipping requirements. We've seen port strikes in the US, we've seen global tariffs, we've seen Eastern European tensions, now the Gulf conflict. Much of the risk I see as being in the logistics team, and where the team that are moving the goods around, not just the kind of hot shot traders that are sitting there deciding whether to be long or short. So our clients have actually put quite a lot of energy into their ops teams and ensuring that they have the right people there. The next slide, please. By far, the biggest concern we see is the shortage of talent coming up through the ranks, though. We are concerned about who the next leaders of our commodity will be in our commodity space. This could be due to commodities not being kind of considered sexy, I guess, 10 years ago. Many companies not investing in talent, companies focusing more probably on the bottom line rather than investing in grad schemes. And also another trend that we saw a few years ago was, and largely for the right reasons, companies hiring local talent in local, particularly originating countries. This works perfectly fine if the companies rotate those people through the business, giving them a broad global experience. But often too much in recent years, you've seen the companies leaving the local talent in those local countries. They then hit a glass ceiling and end up leaving, and we lose the talent. With supply and demand working perfectly in human capital as it does in commodities, this means that candidates, professionals with kind of 8 to 12 years experience in commodities, their salaries are increasing, and companies need to come to specialist search firms such as ours to find this scarce talent, or unicorns, as I think you said in your introduction. So on the face of it, that's great for companies like ours. But I've been around since 1992, as I say, in the commodities, and I'm far more concerned about the health of our industry in 10, 20, 30 years' time and further, ensuring that we continue to grow and develop with ingenuity, sustainability, and of course, increasing profits. What can we do? So, sorry, next slide, please. Education, that's what we can do. We work closely with some universities and with another former trader, actually, Matt Halsell, who's developed what we consider to be the best commodity education course, the Commodity Hub, which is a year-long course. Students that are in their final year that are interested in commodities can come along for this course, and they literally taught from farm to plate in this kind of interactive course where Matt brings in professionals, from all over the commodities spectrum, freight traders, sugar traders, all over, to come in and speak to these students and really impart their knowledge and experience to them. We then work with Matt to help navigate these students into their paths that will best suit their skills and interests, so that we hopefully build this talent pipeline entering our commodities markets to protect the market in the future. What makes a good commodity trader is probably, next slide, sorry, please. Makes a good commodity trader is probably one of the most frequently asked questions by these young professionals that enter our markets. And my answer is always curiosity and humility. I think you have to be curious to look under the bonnet of what's really going on. All of the different areas in our awesome sector, and humility in order to stay in the business for long enough. And when Matt was asked recently in a presentation by one of the students, what's the most important thing that a fresh trader should do? His answer was, if you make a mistake, own it and tell your boss immediately. And we've seen with the fall of Barings Bank and other things, if people don't own it and let people know immediately, these problems compound. So on that note, I hope I've piqued some curiosity here, and any mistakes or misrepresentations that I've made, I fully own, and I'll tell someone about it. But no, thanks very much. And if you want any young people entering the market would like some advice on the areas in commodities that are interesting, be it sugar, coffee, cocoa, grains, oilseeds, and globally, please do get in touch. And any companies looking to hire, whilst we do C-suites and traders and some of the top talent in the world, it's a passion of ours, actually, that doesn't make us any money, but it will do for the future, and that's to get these younger professionals in and into what is an awesome commodity market.
Yeah, Andrew, so before we let you go, there is a very important and interesting question. We have seen that you talked about Mr. Trump tweeting, or maybe Truth Socialing, right? This has created a vacuum where it is just not about understanding the commodities or just the economics. We are talking about those who understand geoeconomics, right? And
Absolutely.
that is a trait which I've seen, across the large mid-sized companies, nearly absent. And you don't even have that expertise, which is off the table, available in a huge quantity, right? Somebody who have dealt with government, who understand the policy cycles, who understand the mindsets of the geopolitics, at the same time, who understand economics and commodity. And these people are definitely are at the stage where they don't want to be aligned to one company. Do you see the opportunities also for such high value people when it look as on advisory or a consulting roles? Do you see that market also increasing?
Absolutely, no, we do, and particularly as I kind of mentioned this outside investment that we're seeing from, for instance, Saudi, that have got a huge fund to protect food security. You see, the Chinese trade houses. You see Abu Dhabi, and so I think this global macroeconomic talent to go in and be able to advise these entities, these countries on how best to protect their food security in the future. I think it all ties into the same, and ultimately, water being a hugely important factor as well, and security across the board in order to continue to feed our growing world.
So again, one more question, because it just popped up in my mind. See, culture of trading desk are pretty cutthroat, right? So far they have been like that. And the game was easy. Now we are having AI where it is playing its own role. So maybe someone who's on the top of the ladder is not very enthused with AI. He still believes in human intelligence, while someone who is just new in the industry, he believes that if 20 agent can do this work, why my boss doesn't want them to do it rather than me doing it, because I have to just pull data from so many places. That's all. It's no rocket science. So Gen Z, they have a different thought process, right? And those who are half Gen Z, like me, who want to be actually who are using all these tools, but at the same time, we also wear different type of hat. How do you see the corporate culture or the DNA of the organization, which need to be recalibrated with the current realities?
Well, this is exactly why we're trying to work with these young professionals and get them in. There's a lot of dinosaurs at the top of these companies, and we do need original thought. We do need some the commodities markets. Yes, they're traditional and very old markets. Some of the oldest professions in the world. However, we are in a fast-moving and fast-changing world. There are ways, I think, particularly around risk management, and also particularly, for instance, you can run code that will track back, excuse me, which will track back over the last 100 years very quickly, and pull out a point and figure chart to show you the technical the movements of a market, therefore predict future movements of a market based purely on the technicals. That would take a person a long time to do, and we have programs that can do it, in nanoseconds. So the way the market is moving, yes, I think AI is important, and I think having people within all of these trading companies who understand how to best use the AI is very important. An interesting thing that I heard recently as well was actually studying literature and reading for these young Gen Zs is important, because a lot of them don't, but then how to articulate into the AI to get the message articulating. Maybe I should learn how to articulate a bit better, but to be able to give the message to the program in order for it to give you the answer that you want is key. So I think we look at all the balance of skills across these young professionals and where they can best fit in the markets.
Yeah, so Andrew, actually, I'll just give you my own instance. So what happened? We collect a lot of data. Predominantly, we use a lot of APIs to pull that data, because that is easier way of doing it, rather than actually going on each and every page and then look at and then adding the data. And some sites still they don't allow API. For example, what we call Indian marketplace mandis, right? To collect that price, actually, they have nothing like API. So my colleague, who is the CEO of HnyB, Neeraj, who is also in this call, he was the person, actually, he was, because of his understanding, what is outlier data, what data not to take, and all that things. He has his own human intelligence. So he used to create and work on that. And he was having coffee with my son, who is doing his bachelor's in AI and data science. And he said, no, dad needs this. Give me 15 minutes, then I'll talk to you. He was doing this stuff on his computer. And after that discussion and all that, he asked him, why you wasted so much time doing this? I'm having agents which can actually scrape this data. He said, no, you don't understand. Some data can be wrong. We have to. He said, okay, fine. Your human intelligence, I can codify it and then actually see to it that outliers are removed. And Neeraj asked me, should we do it? I said, give it a try. It's a free of cost. He's my son, right? And you'll be surprised, what it used to take 30 to 35 minutes for Neeraj and me, right, in the morning to do some stuff. Now it is hardly 60 seconds for us. So that's where I believe, we sharks, we dinosaurs, we pythons, we need to look at the young talent, because they are having out of the box thought process and deep understanding of technology far better than us.
I totally agree, and one of the motto of Matt Halsel's Commodity Hub is you're never too young to teach or too old to learn, and I think that's something that we should really carry with us into the commodity sector.
Yeah, perfect. But after all this, Neeraj's work has not decreased, because previously he was tracking 8 to 10 markets. Now he tracks 15 to 20 markets. his load has increased. His load is
exactly
same.
Right. Yeah, this is exactly right. I think AI will actually create more jobs. Yes, there will be some jobs that will be taken from AI, such as some of the analytical research stuff. However, it will allow humans to analyze that data even deeper and even better, which will create growth and profits and therefore jobs.
Perfect. Thanks a lot, Andrew. It's a pleasure to talk to you. And if
Likewise.
I'm not wrong, you're based out of London, if I'm not
Based
wrong.
out of London, yeah, OCR Commodities. But we are truly global. I spend most of my life on a plane. When we work with clients, we go over and we sit with the clients. We want to understand the culture in the company so that we can find the best talent. So really, we are truly global.
No, in fact, the reason I ask is that actually I'm flying tonight, reaching tomorrow morning London for a week. So maybe if you are around, let's have a coffee sometime.
Let's do so. Yeah, please get in touch. I'll be around all next week.
Perfect. So thanks a lot, Andrew. Pleasure talking to you. Now, with that, we go to our next speaker, and our next speaker is Filippo Roda. He is a highly specialized commodity market analyst currently serving at HnyB, one of the Europe's premier agri-food intelligence and forecasting firms. Based in Italy, he leverages advanced econometric modeling and big data analytics to deliver high precision price forecasting and volatility analysis for the global sugar and soft sectors. His professional focus centers on providing data-driven procurement strategies that enable multinational food corporations and agriculture producers to successfully mitigate international price risk. Welcome, Filippo. Pleasure to have you, sir.
Good morning. Thanks for the invitation and for your kind introduction. Good morning, everyone.
Perfect. So straight into the question, how do you see Europe's sugar balance sheet going forward?
Yeah. Well, first of all, what I want to highlight is that the European Union sugar market is currently characterized by an unexpected surplus and a much more comfortable supply situation than many expected a year ago. Consider that the last marketing year, the 2024-2025 marketing year, despite a roughly 10% reduction in sugar beet area due to weak price incentives and much more attractive alternatives such as cereals and oilseed, sugar production actually increased and reached its highest level since 2021. And this was mainly the result of a very favorable weather condition that pushed the yields, European Union yields, to the highest level since 2017. So at the same time, sugar consumption remained broadly stable with only a slight decline. This is mainly because of consumer preferences of having a lower sugar content in food. And basically, as a result, sugar stocks increased significantly, reaching the highest level, at least in the last 10 years, since 2014. Okay, so this record stock level supported the European Union export with a record net export from the region. So the European Union is nowadays a net exporter of sugar with an export of more than 1 million tons. And this, of course, contributed to the downward pressure we have seen on prices in the European Union over the last year. Now, coming to your question, looking ahead, I guess that the situation is likely to change. Indeed, the weak profitability of sugar is experienced this season has further discouraged planting the season. After last year 10% drop in sugar beet area, we estimate an additional reduction of around 5 to 7% for the upcoming crop, with Germany, that is one of the key producers in the European Union, showing even a larger declines, more than 10% decline in sugar beet area. And now, if we assume average sugar beet yields, European Union sugar production could fall by around, according to our forecast, 14%. And this would lead to a gradual drawdown of the record stocks accumulated during the last marketing year. And now, given the, I would say, relatively inelastic nature of sugar demand, the European Union could potentially return to being a net importing region. So basically, overall, in Arete, we expect lower stocks in European Union, a tighter balance sheet, and a market that is significantly less abundant than in current year, in 2025. And furthermore, consider that the recent hot and dry condition observed across part of Europe represent an additional downside risk to yields. Of course, the starting point is a starting point of abundance because beginning stocks are high. Of course, we believe that stocks are gradually going to decrease during the next marketing year, especially in the first half of 2027. I hope I have answered your question.
Perfectly, Filippo. In fact, you have more than answered my question and also given a perfect perspective, because in the introduction itself, we were talking about the possibility of the challenges making Europe a possibility of becoming on the edge, right? A budding importer, right? With all the constraints around it. So next question to you, Filippo, is that what are the current price dynamics in EU compared with the international market, and how they might influenced by expected supply-demand balance developments. And you know that actually, like, you know, the geopolitics, you know, the currency issues, you know, the logistic issues. So how do you see that actually, like, you know,
Sure.
this whole thing
To answer
unfolding?
this question, please let me briefly share my screen so I can show you a chart
Please.
from our market intelligence platform. Here we are. Just confirming that you are seeing my screen, please.
Yes, we can see a screen, sir.
Yeah, here we are. This is the graph. So basically, in orange and blue, in this chart, you can see international sugar prices, financial prices in the intercontinental exchange, and respectively, the orange line is raw sugar and the blue line is white sugar. In light blue, instead, you can see prices in the European Union, okay? And what clearly stands out is the strong decline in European Union prices over the last year. Consider that prices have fallen from around 650 euro per tons to approximately 500 euro per tons today in the spot market. And this represents a drop of more 20%. And the main driver behind this movement is the record accumulation of stock we have discussed earlier, okay? So basically the abundance of sugar in Europe pushed domestic prices closer to export parity levels, so closer to prices of international white sugar to make European Union competitive on the export market. At the same time, and you know, at international level, prices were also under pressure because of a global surplus recorded during the last marketing year with relatively high production from key exporting regions like Brazil and India. So as a result, we have seen a significant convergence of European Union prices towards international levels. Now, again, looking ahead, again, the picture could become quite different according to our analysis. Indeed, if European Union production declines as expected and stocks begin, let's say, to normalize, the European balance sheet will become tighter. And in that scenario, European prices could start rebuilding a premium over international prices. And this is especially true if the region returns to being a net exporter. So at the same time, international prices may also find support from slower growth in Brazilian sugar supply, and this is particularly if ethanol production remain relatively more attractive, also due to energy market tensions linked to the Middle East conflict. You mentioned several times geopolitics. And so basically, we believe that both markets could receive support, but the upside potential may be stronger in Europe. It is also important to remember that European Union remains, I would say, a protected market. Indeed, import duties on out-of-quota raw sugar can exceed 300 euro per tons, providing structural support to domestic price, especially in the event of being net importer. For this reason, although a return, let's say, to extreme price levels since seen in 2022 and 2023 appears unlikely. Why? Because beginning stocks are higher, because energy crisis nowadays in Europe is less intense compared to energy crisis we had in between 2022 and 2023 with the Russian and Ukraine war. But however, a recovery in European Union sugar prices cannot be ruled out if supply tightens as expected. So basically, all is going to depend on yields, but the starting point is a 10 decrease in beet areas last marketing year and a 7% decrease in beet year this year. So if you consider El Nino development, hot weather, if you have lower yields, the likelihood that European Union being again a net importer is quite high. So basically, we believe that a premium of European prices over international prices can build again, making European Union again quite attractive as an importer region.
Perfect, Filippo. And see, actually, we are already seeing certain impact of El Nino. I'll just give you an example. While there was not too much of parity for export from India of sugar, we still had possibility of, like, you know, the government had allowed a quota of close to 2 million metric tons of export. right? They just reached 0.7 to 0.8 million metric tons, and then the export ban just was pushed. So that means availability of 1.2 million metric tons just being removed overnight. There are El Nino challenge in Thailand as well, right? And you know that Asian countries, they want availability more than affordability. So there is a possibility that actually, like, a lot of other countries also, including Thailand, right, could become protectionist. So we are seeing that the correlation between these events ensure that the correlations between traditional markets somehow get disrupted. And when these type of things happen, how do you see a global procurement desk of a large corporate, multinational corporate, take care of such scenario or could see the early warnings?
Well, consider that in general, over the last few years, I would say after 2020 crisis, commodity markets has become significantly more complex. The first challenge is growing frequency of exogenous shocks. Okay, this includes not only weather-related disruption, but also currency volatility, which directly affect export competitiveness, energy shocks, logistics disruption, and that often interact with energy markets. And at the same time, the policy and environment you mentioned, for instance, has become increasingly complex. Export bans, import restriction, subsidies, environmental regulation, tariffs. We mentioned several times Trump administration. And all of these factors are now playing a much larger role in shaping global trade flows, price formation across agricultural commodities. And also you have to consider that also interconnections among commodities have become stronger. Markets can no longer be analyzed in isolation. For example, you mentioned the relationship between sugar, corn, and energy markets through ethanol production that is becoming increasingly important for understanding price dynamics. Now, what actors along the supply chain can do to mitigate this risk, to mitigate this volatility? I think that the first step is indeed to recognize that commodity markets have become much more complex than they were a few years ago. So basically, procurement teams can no longer focus only on fundamentals of the commodities they buy, but today they also need to monitor the factors that I've mentioned, such as weather developments, energy market, exchange rates, trade policies, geopolitical risks, and so all exogenous factors that can have a significant impact on prices. So basically, for these reasons, I guess that multinational food companies need a more structured and data-driven procurement approach. Market intelligence and price forecasting tool can help companies. This is what we do, for instance, better understanding market dynamics, identifying risk, and optimizing and maximizing their buying strategies, but also their risk management strategies. Consider that financial markets offer valuable risk management solutions. Hedging instruments such futures and options can help companies managing price volatility and protect margin. This is important to remember that the risk management is not the same as speculation. So the objective is not to predict every market move, but to reduce exposure to adverse price fluctuation and to these strange and new correlation and new volatility phenomena. So basically, I guess that more broadly, procurement decisions should be based on long-term strategy rather than on emotions. Periods of high prices are often followed by market correction, just as periods of low prices can eventually lead to tighter market and price recoveries. So basically, and I'm over, failing to recognize these turning points can have a significant impact on competitiveness of market operators. So basically, in today's environment, companies that combine market intelligence tool, forecasting capabilities, and risk management tools are generally better positioned to navigate volatility and, of course, to protect their margin.
Perfect, Filippo. Thanks a lot for such an excellent explanation. And I totally agree with you. Emotions, keep it for your family, not for trading. Right? And any emotional trading, we have seen that what happens is that suddenly something goes wrong and everybody's in the market. And in the start of the conflict, even in the West Asia, we found that all the commodities were like, going haphazard, right? Oil reaching or touching close to 120. We saw wheat going to 670. So we saw, And now,
You
right?
remember what happened, for instance, with sunflower oil in Europe during
Yes.
2022. For 5 months, everyone was saying that there will not be more sunflower oil in Europe at all. But then in 1 year, the market has a certain degree of resilience. So basically, yeah, emotions. Basically, with emotion, you just feed volatility. So of course,
Yes.
you have to keep attention on markets, but emotion don't play a role in maximizing your margins.
Totally agree, Philip. That's why I said keep emotions for family. It's good there, not on the trade,
Exactly.
not on trade floor. Thanks a lot. It was pleasure having you, sir. And
Thanks.
in case you are in London for International Gain Council, let's meet just like last time.
There will be one of my colleague. We share your
Connect
con-
me.
your
Connect,
his contact. Yeah.
connect me.
Cool.
We'll have a coffee together. Thank you. Pleasure
Thanks,
meeting you.
Deepak. Bye bye.
Bye. So now we have our last speaker and a very interesting one. It's Saira Ali. She's an expert agriculture economist specializing in global sugar research at Global Data Agri, delivering the data-driven market insight used by international trade houses and policymakers. She's a leading analyst of global sweetener fundamentals and biofuel mandates, focusing on identifying long-term production trend across Brazil, India, and Thailand. Her analytical rigor provides essential clarity surrounding the sticky surplus era, translating complex regulatory policies into clear, actionable commercial strategies. Welcome, Sarah. It's a pleasure to have you on the show.
Thank you. Nice to meet you as well. Nice to be here.
Perfect. So, Sarah, does the underlying fundamental data suggest that the global sugar market is entering into sticky surplus era? And if you say which origins will drive this trend?
Let me discuss the previous crop year to begin with. So, for example, in 25-26, the crop year brought significant surpluses, which exceeded 3.5 million tonnes. And this was ultimately driven by higher production in the EU, China, Brazil, amongst others, whilst other producers disappointed, such as India. I mean, during this time, a lack of Indian exports was ultimately beneficial to the world market as it wasn't adding to the already significant surplus. But stronger crops in the EU, China, and Pakistan resulted in much lower import demand, meaning that stocks were built up to very high levels, particularly in the EU. Going into 26-27, we don't see these surpluses being built back up to these levels. In the EU, for example, and this is including the UK, in particular, they've taken quite a hardline stance around area reduction, and we estimate around 7.5% to 8% of area has been reduced in 26-27. This ultimately implies a reduction in sugar production of around 3 million tonnes, considering normal yield conditions. So if we assume stocks are drawn down and consumption remains flat, as it has been the past few years in recent history, there are minimal exports. The import requirement of the EU could rise to 2.8 million tonnes or thereabouts. Also, Indian production for 26-27 has been coming off, with general sentiment pointing to a smaller crop, so between 28 and to the higher end 30 million tonnes net sugar production, compared to the much bigger crop that was initially anticipated. But of course, Brazil will be there to plug the gap if the price is right. Production estimates for 26-27 have been rising off of the back of good crop conditions, with many expecting a near record cane harvest. And also, domestic ethanol prices have come off recently, so export sugar looks more attractive. So overall, considering these factors, the outlook for 26-27 points to a small deficit of just under 1 million tonnes. So to answer your question, if we are going off of last year's outlook, then no, the 25-26 surplus I would say is probably part of a cyclical spike rather than the start of a sticky era, because the supply response is already correcting, and really only one origin, which is Brazil, would have the structural capacity to keep pushing these surpluses forward.
Perfect. Sorry, it's perfect. No, I totally agree with you. Like, things look a little bit tighter than they were. And I think the prospect of El Nino impacting India and Thailand both, which happens to be India being like, more of a domestic market, but actually like, taking away any possibility of export for at least 18 to 19 months. And Thailand also, while it is looking at like in roughly 7 million metric ton odd of possibility, could also become a little bit protectionist if they see that El Nino is creating problem, and they are the, I think, second largest exporter. So after Brazil. So I think, as you rightly said, Brazil is giving hope. Rest of the world is little pessimistic as of now when it comes to availability of sugar. Now that brings me to my next question. How should an international trade house translate these complex regulatory challenges and biofuel mandates in Brazil, restriction of trade from India, even biofuel mandates in US, and then suddenly we are also seeing Southeast Asia also like getting into this bandwagon of biofuel mandates, right? Everybody wants ethanol to be in car, not in their glass. So how do you see going forward such challenges?
So I will caveat by saying that trade house commercial strategy isn't my expertise. So I just want to be quite clear about that. But from a fundamentals perspective, I would say there are two maybe key things that they should be watching. So first is the biofuels policy in Brazil is now the single biggest swing on global sugar availability, and Renova Bio targets, hydrous ethanol demand and gasoline parity all feed into mill level decisions on whether to maximise sugar or ethanol. The strategic implication in that case then is that ethanol parity should be modelled as a continuous variable rather than a one-off periodic shock, because mills are now able to switch between either producing maxing sugar or ethanol much faster than they used to. So ultimately, track Brazilian fuel policy as closely as you would track the cane crush, because that can cause quite a big swing into season. The second thing I would say is tracking Indian policy as a whole as a structural regime rather than a series of one-off interventions. So over the last few years, including this year, we've seen export bans, MSP increases, and ethanol diversion targets under the ethanol blending programme. And it's likely that we're treating them as discrete one-off shocks, when in reality, they're all part of one policy regime where the government is trying to balance farmer income, domestic food inflation, and ethanol blending targets, with sugar exports being the residual ultimately. So the commercial implication could be that Indian flows should be assumed as policy driven rather than market driven. So in the sense that even when global prices would normally pull Indian sugar onto the world market, policy can still override that. Beyond this, I would say those are my two key points. As I mentioned, commercial strategy isn't my expertise, but I hope that answered the question.
Perfectly, Sarah. In fact, like, your and my notes perfectly match, because when we talk about India, the priority, and we do engage regularly with the government here, the priority number one is sugar for the consumers, to ensure that, like, there is no escalation of prices, which can disrupt 140 crore or like, 1.4 billion people. Second is the ethanol mandate, because actually we are a large importer of crude oil. We want to get out of that situation. And then third, if there is any chance, then export. So export is not at all a priority on the table of the government's mindset. Secondly, coming to Brazil, see, what I also see is that as we move forward, and this war is getting, I would say, lengthened for various reasons, while there is no hot war, but there is like, restrictions, right? Crude is not moving. Eventually by August, even US, which is working as a war chest for delivering crude to the world, will start drying up, and they will look at their own internal politics because of the upcoming elections, midterm elections coming there. They might not be very keen to export too much of crude oil, maybe by middle of July and early August. And this is where the whole of the world, which can produce anything which is known as maize or sugar cane, right, would like to move as much as possible to ethanol. And that might put a little bit pressure on the sugar side or the sweetener side of it. And your expertise is tracking sweetener. How do you see this unfolding when we talk about cane sugar, beet sugar, and even alternative sweeteners going forward? Do you think that alternative sweeteners now is going to be coming, I would say, in a more mainstream than in the past?
Yes, absolutely. So the real competition for sugar is largely from alternative sweeteners such as high fructose corn syrup and high intensity sweeteners. And the landscape has been changing for quite some time, with consumer sentiment shifting towards healthy, natural, unprocessed forms of sweeteners on food. But what's important to remember is that this trend is asymmetric across geographies. So alternative sweeteners have been very established in the US, for example, for decades. So in fact, the newer disruptor is probably low-calorie alternatives, which now make up around 32% of total soft drink consumption in the US, and compared to roughly 13% in Latin America. Uptake has been slower in Europe, but it's absolutely it's catching up now in the form of non-caloric sweeteners and low-calorie alternatives. And this trend is quite easy to demonstrate in certain sugar-containing products such as soft drinks. And this is because the switching mechanism from sugar to a liquid sugar is much easier in the manufacturing process. So low-calorie soft drinks are now taking up a much larger share of the entire soft drinks market, and this is being taken away from what used to belong to the caloric soft drinks section of that. So we're seeing the switch from caloric soft drinks to low calorie. This is driven again by health awareness and trends, and we're seeing this much more across Europe, the US, and even South America. And even within alternative sweeteners, we've seen some views shift from use of non-kind of naturally derived sweeteners, such as aspartame, and towards stevia, because it's a plant. People view it as, oh, it's more healthy, it's more natural. It's kind of derived from a crop rather than a chemical. But ultimately, the reformulation trend is largely an untapped market in Africa and parts of Asia. And also sugar taxes are a big influence on this, and they've expedited a trend towards reformulation. But I mean, the caveat is that it's much harder to replicate with food items. So things like durability, consistency, and taste in actual food items, it's very hard. There's no perfect substitute. So you end up with a net effect that is ultimately a reduction in sugar-based foods, is partly being offset by the rise in per capita consumption growth in emerging markets. So our forecast is that we see sugar demand slowing compared to the 10-year period in the early 2000s, but we still see some small growth of about 0.3% per year to 2030.
Perfect. Sarah, in fact, I love, you talked about stevia. I'm not a big fan of stevia, but I love the monk fruit one. It tastes as good as sugar, right? So now the last question to you before I let you go. So we know that actually, sugar production is, and its trends are pretty complex, right? According to you, what could be a significant blind spot in current institutional models? Whether we are talking about from the policy front or whether we are talking from the front of overall availability. So what could be a blind spot which maybe people would have missed?
Okay, once again, I would say maybe two things come to mind, and the first is yield modelling. So most institutional models still use mean reverting yield assumptions, when ultimately the underlying variance of yields is widening and it's becoming more uncertain. And secondly, the speed of the Brazilian mix switching, where models might treat it as a slow-moving parameter, mills are now responding to price signals much faster than the historical data might suggest. So to expand further on my first point on yield modelling, so we're seeing more unpredictable events such as droughts in Brazil, uncertain monsoons in India, once again exacerbated by El Nino, increased pest and disease pressure in Thailand and the EU, and potentially we rely too heavily on historical yields that may no longer reflect underlying climate and agronomic conditions. So if we're still using models that revert to mean average yield assumptions, then we are effectively might be anchoring our current assumptions on different set of parameters that don't necessarily translate to the landscape now. And ultimately, this might mean that downside production risk might be systematically underpriced. The second point in Brazil, once again, I've mentioned this before, but most models treat the sugar ethanol mix as a single parameter that might get adjusted season by season. But Brazilian mills are becoming increasingly dynamic in how quickly they can shift from producing sugar to ethanol, even within a given season. And the speed of their response to price signals is faster than a lot of models assume, because they anchor on historical mix ratios from periods when switching might not have been as immediate. So in theory, this means that surpluses could be built and cleared faster than our balance sheets imply, which I think is a key point to address.
Perfect. Thanks a lot, Sarah. It was a pleasure listening to your highly insightful thought process and interventions. Thanks a lot for joining, and it is a pleasure to have you here.
Thank you so much.
My pleasure. So with that, we come to end of the session on sugar, Europe, Middle East, and Africa. As you know that it was ultimate session, and we would be having the last session, right, which would be coming up 9 a.m. New York time, where we'll be covering sugar from the angle of what Sarah was talking about, Brazil, because Brazil is part of South America, and this session is all about Americas. So that would be the last session of this marathon, humongous effort which we have put in, called Commodity Week World 2026. As you know, we started from Monday, and 3 sessions each day covering commodities including maize, wheat, rice, oilseed and edible oil, pulses, and today sugar. So we have tried to get you insight from some of the sharpest and the best minds in the world. And the idea was to ensure that we are able to democratize the market intelligence on the commodity which are impacting all of us. And at the same time, also see to it that no region is missed out. These 6 days would have given you a complete 360-degree understanding of complete agriculture commodities marketplace and ecosystem. With that, I'm happy to sign off as a moderator for this session. Looking forward to see you one more last time for the current Commodity Week World 2026, because as you know that we do it twice a year. Generally, we do it in a shorter format, but this time we have taken a huge leap of faith because of my team. Especially, I would like to congratulate Neeraj, who is CEO of HnyB, who drove me that let's go beyond what we believe is possible and stitch around 125 odd speakers from 39 countries. And it's a humongous task which he has been able to achieve. So kudos to him. Definitely you see me more on the screen talking, that's the easier part of it. The hard work which has gone behind it is the team at HnyB, Know Your Commodity, led by Neeraj. So I would like to thank Neeraj and the team for the great work they have done. And also a little bit emotional part, because for past 6 days, morning to evening, 3 times for nearly 2 to 2.5 hours in front of screen, talking to expert, getting all the insight, getting all the adulation, all the love, and also the views. So we just crossed 89,000 views of so far the 17 different sessions. As this session is just getting over now, I believe if we are lucky, we would touch that mark which we targeted when we started, that we should have on multiple handles total number of 100,000 views, because we believe at least 100,000 people would be interested in one or another commodity in one or another region or our country. So with that, signing off, thank you. And again, looking forward to see you one more time in this month in the evening, 9 a.m. New York time, and that is 6:30 p.m. Indian Standard Time, and I think 1:30 p.m. GMT. Thank you.